Welcome back to the show. This has been quite a couple weeks as these tech trades that had been a little comatose to start the year came roaring back. What do you make of it?
So, Oliver, back in early March, that was the time to get long growth. Some of these mega cap names, they had been more oversold. The Russell 1000 growth relative to the Russell 1000 value had become, on a 10-week rate of change, the most oversold in the last 10 years that I can find since the last recession. And that was in early March. That was the time to bet on a bounce in some of these mega cap names. Now it's getting a little bit extended. I was just looking at that same relationship, and it's about as overbought as it gets on that 10-week rate of change. So, as you know, we downgraded our market view yesterday to neutral, thinking that we're due for a pullback, and I do actually think it could happen in some of these big cap names.
What you describe in your note is a power on stall that could potentially be arriving. And within that note, you point out the 10-year yield. Walk me through what that means. Is that real push we saw higher? Obviously, that overbought that we got is also pulled back now.
Well, let's talk very quickly about what a power on stall is. In aviation, it's, you know, when you're at an air show and the plane's going across the horizon and all of a sudden it pulls up and the smoke and the fog is going and it looks like the plane's going to keep going up forever, and all of a sudden it stops going up and starts to come back down. Even with the most power it's got, it's lost the lift. And I think that's what we're in. It's not like there's no power in the market. It's not like the fundamental backdrop is really negative. It's the opposite. As you know, I'm very optimistic economically. It's just had one heck of a move to a point where even Jerome Powell on Sunday at 60 Minutes talked about how substantial the progress has been in economic activity and how strong the second half is going to be. That was his opener. It wasn't that we still have millions of unemployed. It wasn't that the risk is here. It was optimism. And then if you couple that with the CFO, Duke University CFO magazine survey, it showed the third highest, most optimistic reading toward their own companies in the survey's history. So, or at least in the last 20 years. So again, it's been a good environment, but a lot of that has already been discounted near term.
Okay, so that discount, how much of a discount, Tony? I mean, we're looking at some of these companies that are on the reopen side that are at multi-year highs. You can take a look at these retail names, and many of them are trading above where they were pre-COVID. And then on the flip side, some of the tech names that were sort of left for dead in that high growth, high valuation category, they're now breaking through resistance. Case in point, Tesla. So where and how much has been overextended here?
Well, I think it's a broad overextension. You know, remember last summer when we were doing the interviews and literally people are making fun of us because we wanted to get long the banks and tanks, or the banks, the financials,
yeah, the banks
and the
and tanks, I remember.
Because all of the money was coming in. You knew that the huge amount of money was coming in and it was going to end up in a rising 10-year. So ultimately, now to chase those with the level of extension that they have, I think is a mistake. So here's the evidence for that. When you look at the 10-year note yield, if you look at a 10-week rate of change on the 10-year note yield, it reached the highest in its history about a month and a half ago. We downgraded the financials because once it reaches that kind of spike, you know, it has that kind of thrust higher and then stalls, power on stall, it tends to lead to a correction in those economically sensitive areas. And that's what we've had, is a relative correction in those areas. So the market, between the 10-year note yield coming down, between even with strong economic data, with the cyclical sectors such as the financials, industrials, materials, and energy coming down on a relative basis, despite it sent a message that things just got a little bit too overheated. Again, I want to attack weakness, and that was the impetus behind lowering our rating on the market. I want to take some profits and have some money available to attack weakness versus having to react to it with fear.
Tony, right now there is a message that I hear a lot of folks saying that the market has gotten comfortable with yields where they are. The problem I have a little bit with that is that yields haven't gone anywhere for the past 3 weeks now. They've gone sideways to lower. So should we leave that, is that bear case, that kind of volatility case for the way rates or the kind of alternative type of banks and tanks versus tech, whatever that economically cyclical impulse was doing for tech in a negative way, is that behind us, or can it come right back if the 10-year stops going down like it has the last 3 weeks?
Well, I think it could be a combination of things, but yes, if you get a rise in the 10-year back toward the 177 level, that should put a little bit more pressure maybe on some of the mega cap high valuation names. But again, I think what we need here to really, and it's not because you're negative, it's not because you're so bearish, it's because you need the buying power to create that next leg higher. Right now we're grinding to the upside with this, we call it the rotation sensation. One week you've got a big up move in some of the mega cap names like this last week. The next week it's the high value names that are lifting the indices, and it just keeps the index kind of going up a little bit each day. What we want to see is a real thrust, and I think the only way you can do that is a broad-based sell-off. Frankly, I'm not sure. I think we come on these shows and we think we know where it's going to come from. In 35 years, I've never seen a correction that was really predictable, because it wouldn't happen if it would already be, that factor would already be discounted prior to the correction.
Tony, one of the other things you're looking at right now as we're talking here about some of the macroeconomics, just kind of the sentiment view, the one that you look at is the CFO outlook and the optimism here from business leaders. What does that tell you? That's elevation right now that looks pretty darn good.
Well, when you look at that chart, the only time it's been higher was the fourth quarter of 2019. Not a great time to be a buyer. And again, the first quarter of 2004, which was after that huge rush. And then you had a sideways kind of grind lower of about 8% over the course of the next 4 months. And that's what we're just looking for. What happened in 2004 and 2010. It's not unique. We're coming off of a credit-driven recession. Obviously, the reason was the pandemic, just like obviously the reason last time was the great financial crisis. The reason is always different, Oliver. But once you come out of that and things start to look better, you get that kind of enthusiasm, and it's coupled with a move higher in rates, and the market has to digest that.